Hi, in this video we're going to look at some of the issues related to estate planning and the taxes related to estates, gifts, and inheritances. Estate planning is a process that people go through to determine what they want to have happen to their own persons as well as their assets when they die. One part of estate planning is developing what's called a living will, and the living will sort of lays out your desires for how your end-of-life medical care will be carried out. For example, do you want to be resuscitated if your heart were to stop in the hospital? And the idea is to try and, to the best of our ability, observe your desires as part of your living will, though there's no guarantee that your do not resuscitate or DNR request will actually be followed through on, because if you don't have that living will on your person, or if you haven't communicated those desires to other people, then it's impossible for EMS or somebody else to know what you want, and so they will generally err on the side of resuscitating people or attempting to resuscitate people unless you've made these desires known to your friends and family. There's also what we call a last will and testament. That's a legal document that you create and sign that gives direction on how your assets should be distributed, and then also comes up with issues like, what do you want to do with your children if you were to die and they're still dependent? What do you want to do with your property? How you want to set up your finances for those people who are left behind? All of this is generally covered in your last will and testament. And it is very important for you to have, if you have significant assets, as well as if you have children, because you want to make sure that there is clear direction on how those two parts of your life will be managed in the case of your passing. Purpose of wills, again, is to state how you want things distributed, how you want to see things handled. You generally will appoint somebody called an executor who will make sure that these wishes are carried out to the best of their ability. And you'll make sure that you record any and all information related to how you want things handled after you've died. If you don't have a will, what will happen is that your assets and all of these issues will be taken care of by what's called a probate court. And you're basically leaving it in the hands of people who don't know you, don't care about you, have no idea about your background, and they're going to be the ones that make the final decisions. And that's why it's important that if you have assets and you have people that you care about, that you make sure that you have a will put together in a timely fashion. Estate planning changes. The rules change all the time. Taxes change all the time. And so it's important that you are aware of the state and federal laws at the time that you're beginning to put your plan together. It's important also that you recognize that the best way to do that is to seek legal advice from someone who is an expert in this area. Currently, there is an estate tax at the federal level, though that could change between now and the time you're watching this video. Currently, the federal tax only applies to assets with a value greater than $10 million. So if you have less than $10 million in property and investments and other sources of income like insurance proceeds, then you're not going to be taxed. But if you have more than $10 million, it's going to be taxed. There are ways to avoid that federal tax, and that's where an estate planner can help you decide where to put your money in order to prevent taxes from eating away at your assets. Things like gifts to your spouse or your children or charitable contributions are all exempt and would limit the amount of money available in your assets to be taxed. Some states add an inheritance tax on those who receive disbursements from your estate. So if you give money to children or to relatives, some states will actually tax that amount of money. In Virginia, we do not currently do that. One way to avoid the estate tax is to give away your money while you're still alive in order to reduce the amount of assets that you have. If you choose to give gifts, you can do so before you die, and those gifts can be considered tax-free as long as those gifts are less than $14,000 per year. So that might be one thing you can do, is if you have $10 million in assets, start giving away gifts to people gives you an opportunity to see them enjoy that gift while you're still alive, and it will save you and your estate taxes in the future. If you give a gift greater than $14,000, the amount over that $14,000 threshold will be taxed as regular income. Again, all these rules are constantly changing, and so please make sure that you always consult professionals to help give you the most recent information and the best guidance on what will limit your tax liability and what would be best for you and your family.